Hi, and welcome everyone. I'm here today just to have a quick look on a particular chart. This is in fact the chart we use in other videos, say the Dow Jones Index monthly reviews, and now we can quickly go through it to see how it works. This is actually a very simple chart. Each dot corresponds to a stock, so most of the time we have a certain number of points representing stocks. All these points get displayed in a scatterplot, so if you imagine the area of this chart, well, as a rectangular picture, we can follow its two dimensions, the vertical and the horizontal one. Along the vertical dimension, or the vertical axis, or the y-axis, or whatever you want to call it, we find returns. These are actually relative differences between two consecutive stock prices. For example, if today the price of a stock is higher than it was yesterday, we have a positive return. If today the price is much higher than it was yesterday, we'll have a very positive return, and at the end of the day, whoever holds that quote in the portfolio will be quite happy, because its value has risen. Vice versa, if the stock price today is lower than yesterday, part of its value has been lost, and this makes the shareholders usually unhappy, or very sad depending on the magnitude of the fall and the sensibility of the shareholder. On the other hand, on the horizontal axis, we have a measure for the variation of the stock price over time. Let me explain this a little better. If you look at the most common charts used to display stock prices over time, you see that they are far from looking like smooth lines, and the prices usually go up and down several times from the moment the market opens till the one it closes. What we are interested in the horizontal dimension is how wide the price movement really is. Some stocks, for example, show waves of remarkable amplitude with high peaks and low valleys, while others are much more flat, with small ripples and maybe with some recognizable trend. This measure of agitation or excitement is close to the concept of volatility and is usually related to some kind of variance formula, but we're not going through that now. Anyway, a stock presenting marked peaks and valleys, ups and downs, will be on the right side of our chart, while a stock whose price is relatively stable over time, with few ripples along the way, has a small volatility and will lay to the left, near the vertical axis. Okay, now that we know how to read this chart, let's look at an example. Here we have a dot representing the stock for CompanyX. The first day it lays near the point where the two axes cross each other, so small return and small excitement. Then something happens, say there are some news that make people fear that CompanyX won't perform so well in the near future. They decide to sell, and the next day the point falls below the horizontal line, in the zone of negative returns or losses, because the price has dropped down. But then imagine that some rumors say that CompanyX is going to present a new exciting technology. Hearing that, many people may want to buy CompanyX stocks, and this makes the price rise again, and so does the return. You'll also note that in this case we ended up in the frenzy zone, which means big changes in the stock price during the day. This roller coaster may be due to investors not being really sure on the new technology potential or on how easy it might be for CompanyX to exploit it. Anyway, I believe you got the point, and you now know surely enough how to read the simple chart. Hope you found this tutorial interesting, and if you want to find out how the story evolves, don't forget to watch the monthly reviews where we discuss the Dow Jones performance. Thank you for watching, and goodbye.